Hello, and thank you for listening in to our second quarter investment commentary. I'm Angela Palacios, the Center's Director of Investments. The first half of the year has started out strongly, especially for U.S. stocks, and in particular, technology companies again are among some of the top performers. Other areas like small company stock, emerging markets, and international developed markets are up as well, but at a more measured pace this year. Consumers are feeling the brunt of higher prices in a variety of areas like the grocery store, restaurant, or travel. Even though disinflation is occurring, a return to the Federal Reserve's target of 2% doesn't erase the fact that we experienced higher prices that are likely to stay, even though they won't increase at the same pace going forward. These higher prices for longer are just something that has to become the new status quo consumers need to adjust to. The yield curve remains inverted now for the longest stretch ever, on record for 2 full years. It's important to remember that this isn't normal to get higher returns on our cash than on our longer duration bonds. Normally, taking on more risk in bonds and locking your money up for a longer period of time comes with a higher reward than sitting in money market. While the yield curve will eventually return to normal, the Federal Reserve is taking its time helping it get there. Higher rates for longer has been the story of the Fed this year so far. Jerome Powell continues to stress data dependence and their commitment to the 2% inflation target before making any moves to lower rates. Geopolitics are always something we pay attention to as well. They have the capability to escalate at any moment and spill over into causing market volatility. Generally, volatility from this type of event is short-lived, but can create opportunities for us. Diplomatic solutions and ceasefires are unlikely in both the Russia-Ukraine conflict and for Israel and Iran, so this is something we pay close attention to. On a brighter note, all eyes are on Paris in the coming weeks. Whether training for Olympics or saving for retirement, it's important to remember both require dedication, strategy, and resilience. Competing in the Olympics requires preparation and discipline. Athletes train relentlessly, following strict routines and dedicating years to their sports. In investing, successful investors also need discipline. Regular contributions, diversification, and long-term commitment are essential. For these athletes to make it all the way to Paris this summer, they have to set goals. Athletes set specific goals, breaking records, winning medals, or achieving personal bests in even small ways each day. Investing successfully usually requires defining clear financial goals like retirement, buying a home, or funding education. Your investment strategy has to align with these objectives. For both Olympians and investors, risk management is extremely important. Athletes manage physical risks and avoid injuries. Investors mitigate financial risks by diversifying across assets. Don't put all your eggs in one basket. Monitoring your performance along the way helps you achieve many goals and reach of larger goals. Olympic athletes track times, scores, or rankings, while investors monitor portfolio performance, returns, volatility, and growth. Finally, a podium finish, winning gold. Athletes celebrate medals, while for investors, achieving financial goals is your gold medal. Compound interest over time is your reward.